Good morning and welcome to this Wednesday, June 15th, 2022 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, the big thing you want to prepare for today is the Fed meeting. We got that concluding. It started yesterday, and at 2 o'clock today, we will get the latest from the Fed. It's a little bit up in the air this month. I mean, I think everyone until just recently was expecting the Fed to raise by 50 basis points. But there's been a lot of chatter just in the last few days that the Fed will raise 75 basis points. And I guess it's, whether you're looking at the glass as being half full or half empty as to how you would react to maybe a sudden change in the Fed raising by more than what was expected previously. I think those with a bullish view of the stock market would look at that and say, good. I mean, they're going after inflation. Let's squash it. 75 basis points. Should have been doing this earlier. Stepping up the pace now is a sign that the Fed is actively and aggressively trying to bring inflation under control. And honestly, that's the bigger concern for the stock market right now, long term. It's inflation. It's not the recession. The recession, which I think is already underway, is something that, will be a short-term type of thing. And the Fed's got tools, demonstrated tools over the years to fight that. But sometimes when you get behind the 8-ball in inflation, it can be a big problem. You only have to go back to the 1970s to see what kind of devastation it did. So, you could be bullish and say, well, it's good that the Fed's taking a more aggressive approach. And then, of course, the bears would say, well, they've fallen way behind. They're trying to catch up, but it's too late. We're going to see how the market reacts to this. I have my own thoughts. We had a great session last night with EarningsBeats members, Max Payne for June. And I've made it clear, I think we're bottomed. Well, I don't know if we've bottomed. The point I made last night was we're bottoming this week. I don't know what's going to happen with this Fed meeting. I mean, I hate calling a bottom right before a Fed meeting. That's like, I like these analysts that come out and upgrade or downgrade companies right before their earnings report. It's like, why don't you just wait one more day? Let's see what happens with their earnings. They're telling you one thing and you might feel really good about it, but I've seen some management teams, mislead analysts before. So trying to call a bottom one day ahead of a Fed meeting is probably rather ludicrous. So I put that little caveat in there. I want to see. I think if we go down after the Fed meeting, I think that's marking the bottom. I think the panic and the fear right now is getting very close to an extreme. And so if the Fed triggers another bout of selling, I think that could throw a lot of traders over the edge where they just basically say, all right, throwing in the kitchen sink, baby out with the bathwater, all those, cliches. I'm out. Can't take this market anymore. It's going, to zero. And that's what marks bottoms. If there's one thing right now that I would say is missing, the one missing ingredient to what I would say would be almost a definitive bottom would be the capitulatory selling with a huge rally. Morning, it's like nobody wants to touch a stock. And by the afternoon, it's like, what the heck happened? What happened in the morning? Everything's better now. Sun's back out. That would be nice to see, honestly. I don't know if we're going to get that. I've started buying. I can tell you that. I am more aggressively long right now than I've been at any point in 2022. I believe we're bottoming. If we haven't already bottomed, I think we're bottoming. Just my own opinion. Feel free to disagree. I've been talking about a bottom throughout the year, how I thought it would, at some point we were going to bottom, we were going to start to rise, head back up, have a strong fourth quarter. I'm making the call. We'll see what happens. Anyhow, for those of you that are new to EarningsBeats, let me just take you over real quick to our website, EarningsBeats.com. I mean, I try to share a lot of great information with our community through this free newsletter. So, this is a great way to get to know us without having to pay a dime. Honestly, I mean, I don't want our members to be paying us if they don't feel like we're worth what I believe we're worth. So the best way to just kind of check us out, see if you like the things we talk about, our approach to the market, is to subscribe to this free EB Digest newsletter. All it takes, name and email address. There's no credit card required. You can unsubscribe at any time. You're not going to hurt my feelings. The market is made up of, just trillions and trillions of different things and angles and analysts. And, my style may not fit yours. That's fine. You may not agree with some of what I say. You may not agree with most of what I say. You might not agree with anything I say. That's completely up to you. And I don't get offended by it. The market's very difficult, and everybody has to manage their money based on how they feel is appropriate in their own situation. Everybody's at a different point in life. But I do think this EB Digest will highlight the things that we think are important in the market. Comes out 3 times a week. It's a very quick read, 2 paragraphs in a chart almost always. And it just focuses on earnings gaps, relative strength, candlesticks, moving averages, momentum. I mean, all the things that are important to us, that's what we focus on in the newsletter. So we'd love to have you. We also do free events from time to time. And when we do those, we reach out to our EB Digest community with room instructions to come in and join us. So another benefit of being a part of this community, but we'd love to have you. So be sure to check that out. All right, before we get into what I'm seeing in the market, let's take a look at what we saw in the market yesterday, which was not great. At least the pace of selling slowed down. If there was one positive, I guess we can take from this, or that it was bifurcated and the NASDAQ was showing some leadership, which hasn't been something that we've seen a whole lot of in 2022. Anyway, Dow Jones down 152 points, S&P 500 down 14, NASDAQ up 19, mid caps down 10, small caps down 3. So clearly the NASDAQ was your outlier. That was your winner. If you're looking at winners and losers, the NASDAQ was your winner on Tuesday, rising 19 points. It was nice to see technology back out on top. That was one of the reasons why the NASDAQ outperformed. Technology was the leader, up almost 2/3 yesterday. Energy up fractionally, about 0.2%. Discretionary was up most of the day, kind of fell back late in the day, ended up just down slightly, down less than 0.1%. The laggards yesterday, and this is interesting, on the heels of all the selling that we've seen, look at the S&P, this steep drop down, the Dow, steep drop down, NASDAQ, big drop down. On the heels of all that, the worst performers yesterday, utilities and staples. That's kind of interesting. That's the opposite of what we saw back in December, if you remember. As we were setting those final highs, utilities and staples, defensive groups were leading. That was one of the warning signs that said, get out. Now, the market's selling off and Wall Street is rotating out of utilities and staples and into technology and discretionary on a relative basis. Things make you go, Anyhow, now that's just one day. That's just one day. So, we try not to get excited when we're trying to make long-term calls. We don't want to do it based on one day's action. Bottoms are a process. So you got to be looking at more than just one day. I mean, we've had not a lot of days, but we've had plenty of days in 2022 where we saw setups where technology and discretionary led. So it's not unparalleled, but anytime we see market going down and defensive groups leading to the downside and the aggressive groups kind of being spared, that makes me wonder a little bit. Is Wall Street beginning to reallocate, to the more aggressive areas? Because that would be a pretty good sign if that's what were happening. 10-year Treasury yield. So again, Fed comes out today, later today. Did have the retail sales report come out this morning. That was out at 8:30 this morning. And retail sales fell by 0.3% for the month of May. Expectation was for a rise of 0.1%. If we strip out vehicles, the retail sales number for May rose 0.5%, which was, again, below expectations, which was calling for a rise of 0.7%. So retail sales came in just a little bit less than expected. Again, for me, probably a sign that we're in a recession, or at least that, we're pretty close to the flat line. I think most everyone would agree the economy has slowed. Now, whether or not you call it a recession or, that's up to you. We've already had 1 quarter of negative GDP. I would not be at all surprised to see a second one coming, but we'll see. We'll see what happens over the summer. All right, let's see what else. There was another economic report. The Empire State Manufacturing Index came out at 8:30 as well. And the expectation there was that we were going to see a positive 5.5, instead negative 1.2. So, this is the New York Fed conducting a monthly survey of manufacturers in New York. So basically, they're looking to report the change in a number of different indicators from the previous month. They also are giving their views about the likely direction of those same indicators over the next 6 months. So this is a look at, these manufacturers and these executives from these manufacturing firms looking at not only what they're seeing right now, but what they think is going to happen over the next 6 months. And I can only tell you, when you start seeing negative readings here, I mean, this was for June. May's was minus 11.6. We were expecting June to go positive, and it improved from May, but it did not go positive, still negative. I just see so many signs that point to recession. This is just one. This is a small one, but nonetheless, another sign. And when I look at the 10-year Treasury yield here, of course, the yield's been going up. Normally, what you would think with a recession, the yields would be coming down. That's normally the way things would happen. If you think that, you would need lower rates to kind of stimulate the economy, and investors, knowing that, would buy bonds, because as rates drop, bond prices go up. So normally that's an investment where folks expecting a recession would be heading into bonds. That's not what we're seeing right here. And so what this tells me, these last 3 months have been all about folks saying, you know what, maybe inflation is a problem. Maybe even going back to the beginning of the year, because this is when those large cap growth names finally, started rolling over. I think it was the combination of not only having inflationary pressures, but then also a potential recession, the combination of the two. Call it stagflation. Now, what I believe this is doing is presenting one of the best opportunities of our lifetime to invest in the stock market. I've been waiting and waiting and waiting. I've been screaming patience, been screaming volatility. That's what we should be expecting in 2022. Patience, patience, patience. Let this market play out. I think it's played out. So let's talk a little bit about that, about the fact that it's maybe played out. This was a chart I showed our members last night in the webinar. And it's something I've been talking about all year. And more than just this year. I mean, I talk about it all the time. It's my sustainability ratios. Some of my key sustainability ratios, comparing them to the S&P 500. So that when the S&P 500 is going in a certain direction, do these ratios tell me that that's the right direction? Is that the way, is it confirming that direction, or is it arguing for a reversal? So I want you to look at the S&P 500 as it goes down and puts in these lower lows. This is the beginning of 2022 right here to where we finished yesterday. And you see lower, low, lower, low, lower, low, lower, low. Here's the QQQ versus the spider. So this is the NASDAQ 100 versus the S&P 500. Growth, more growth oriented versus more value oriented. As we keep going lower and lower, this ratio lower, lower, lower. Wait a minute. What happened here? Prices broke down. Yesterday, we actually saw this move up from a higher level than where we were previously. See that? I mean, I would call that maybe a form of maybe an intermarket positive divergence. And if you look back at the top, see the top here, higher prices on the S&P, lower ratio. This is consumer staples or consumer discretionary versus staples. This is what I would refer to as an intermarket relationship negative divergence. Higher prices, lower sustainability ratios. That's a warning. Look what happened afterwards. Now we're coming down, lower, 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 oops, higher. Wall Street's not quite as bearish on the QQQ as it was previously. I mean, everybody's talking about higher interest rates, higher inflation, recession, all these bad things, war, surging oil prices. Shouldn't technology stocks perform worse in that kind of an environment? Especially surging interest rates. Why is it going up now? It had been going down, been following it the whole way. Now it's turning up. Wait a minute, XLY, XLP, discretionary versus staples, turning up. What the heck? Why is that happening? IWF, IWD. This is large cap growth versus large cap value. Lower low, lower low, lower low. Wait a minute. This one's turning up. The Dow Jones US large cap growth index versus their counterpart, the value index. Lower low, lower low, lower low. This one's turning up. Mid cap growth versus mid cap value. Lower, 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 turning up. Small cap growth versus small cap value. Lower, 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 turning up. Every one of these sustainability ratios is reversing while prices are going lower. I don't make this stuff up. This is 2009. I showed this last night too. See how the S&P 500 is going down, down, down? The low in November and the low in March. Prices went lower on the S&P 500. Look at the QQQ versus the spider. It started bottoming out here in November. And when this rolled back over again in 2009 to put in a new S&P low, QQQ versus the spider was going up. Money was rotating to more aggressive stocks. The XLY, XLP, there's your lower S&P, higher XLY, XLP. IWF, IWD going up. Growth going up. Growth versus value, large cap, mid cap, small cap. All of these did the same thing in 2009 at the bottom. How about 2018? I didn't show this one last night. I pulled this one up this morning, was looking at it. This was the S&P when we topped. This was trade war related, remember? October top, there was October, here's December. And remember, right about in here, I remember Fed Chief Powell saying that that the Fed was going to be raising rates at least a couple of times in 2019. And I remember writing articles. I wrote one particular article. I think it was on either December 24th or December 26th. You can go back and look at my article in my Trading Places blog. But I said, they're not raising rates. I said, I don't remember. I think I may have said they were going to cut rates, but I know I said they're not going to raise rates. They're not going to raise rates. And in June or July of 2019, they cut rates. They never raised. Sound familiar? Because right now, Fed's telling us they're going to be raising for the next year. I think they're going to raise today. I think they might raise again next month. I think they're going to, pretty soon, they're going to stop talking about raising because inflationary pressure is going to go away. Once inflationary pressure subside, then they're looking at a recession. You're certainly not going to be raising rates if you no longer fear inflation. We'll see. That's what I'm betting on. Anyhow, look at the final low back in December of 2018. See that move down? Look at the QQQ spider. Higher low. XLY, XLP, higher low. IWF, IWD, higher low. Growth versus value, higher. Mid caps growth versus value, higher. Small cap growth versus value, higher. Why would you do that when the S&P 500 is moving to a new low? Fed's talking about raising rates. We got a trade war. Who in the heck could call a bottom then? Well, all of our sustainability ratios did. Again, let's go back to that chart where we are right now. New low. And every one of these sustainability ratios have held that prior low. Now, maybe we keep going down and these roll back over. That would be the one thing I would watch for, because maybe we go down, keep going down, the S&P gets hit hard, and money rotates back away from all of these growth areas, and they set new lows. Then I would have to reevaluate. But if that low turns out to be the low, we've bottomed. Again, maybe with the Fed meeting this afternoon and all the volatility, do we have a sell-off? Does the market get spooked in the short term? Do we sell off into the close and gap down tomorrow? It's possible. That's why I said I think the bottom prints this week. It may already be in. Honestly, I would rather see a big intraday move down and a big recovery, or a move down and a gap down on Thursday and then a big recovery with some kind of a bullish engulfing candle. Or if we recover, in the middle of the day after being down, maybe it's just a hammer, something like that on top of all these other signals I'm getting. Yeah, I'll call the bottom. So, you can believe me. You can believe these charts. You can ignore them. You can have your own opinions. You can manage your money exactly the way you're comfortable. That's what I would encourage you to do. There are some that look at this market and say, there's no chance. And one thing that, I ignore, and so many people like to get involved in politics in the stock market. All I can tell you is that the stock market does well and poorly, no matter who's in office. The worst thing for the stock market is when you have one party in charge of everything, the Senate, the House, and the White House. The market doesn't like it. Historically, going back since 1950, the stock market has not performed well when one party is in control of everything. But as long as one party doesn't have control, there's always balance of power. So I don't worry about it. I don't worry about politics, and I don't bring that into my discussions. Last night there was a member that sent in a question. I didn't respond to. I didn't see the question until after the webinar was over. But they were taking shots at the current administration. And honestly, I don't care who you support. When I look at the stock market, I try to be as objective as possible. And I really just push politics to the side, because I know long-term politics don't really play a role in how the stock market performs. It's great to talk about. It's great for headlines. It's great to try and pick a fight with the other side. But honestly, with the stock market, it doesn't matter. I don't want to hear about it. I don't care about it. I look at what the money is doing. That is all I care about. I look at these charts. I look at my ratios, and I drowned out everything else. Just my opinion. Again, you feel free to disagree. Let's see. Anyway, so this was the chart of the current market action over the last year. So there's the S&P going up. That was that turn. That was that negative divergence at the top that I talked about at the end of the year. Then we're going down. Now we've got this positive, potentially positive divergence. Watch this. If we keep going up with these key ratios, I don't see the market having much more downside. If you're a believer that we're going a lot lower, you better watch these ratios and hope they turn back over, roll back over. Because historically, the market doesn't go down when these ratios are going up. All right. The other thing that's kind of interesting to me, here's the XLK relative to the S&P. So this is technology relative to the S&P. Now, I'm going to come back to this, but I just want to show you again what the S&P looks like. Do you see the huge decline on the S&P? Now I want to show you the relative. We had that huge decline, but it stopped. With all the negativity and all the, we got financial Armageddon coming, right? Why did the selling in technology stocks on a relative basis stop? Why did we bottom in May on consumer discretionary and can't come back up? Why do we have a little bit higher relative low right now in consumer discretionary? Why did we bottom in April on a relative basis in communication services? We're rolling back over, but we still have a higher low. Industrials, goodness, we're at a 1-year relative high on industrials right now. That doesn't sound right. We've got financial Armageddon ahead of us. Why is money rotating into industrials? Financials, we actually put a low in financials back in December. They've held up on a relative basis. They've actually outperformed the S&P 500 since late December. So those are the 5 aggressive groups. And let's go ahead and look at the defensive real quick. So defensive topped in May. Now they're down in June. This was healthcare. Staples topped in May, lower in June. Real estate topped in April, still going down. Utilities topped in May, rolling over. Do you not see the inconsistencies behind what we're hearing in the media, what we're being told, what we're being programmed to think, and what we're seeing in terms of money? I don't know. I'll let you all stew on that one. I know how easy it is. And trust me, this comes after many, 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 many years of studying stock market history. I'm passionate about it. I love this. I love going back and trying to figure out what makes the market tick, what really drives it to the upside, what really kills it. And these are things I'm finding that are much more important than anything you're going to hear on CNBC. I love, every once in a while I go into CNBC.com, just for, financial news, checking commodity prices, things like that. And I see these headlines, and I love these headlines that have the little pro in green where you have to subscribe, and they're only going to tell you a little bit of all this information they have for you, which is totally worthless, by the way. And they make it so, you got to read it. We're getting ready to crash, but you can only see the first 10 words of the sentence because you have to subscribe. Yeah, just click on something else. Anyway, when I look at the industry groups in technology, look at computer services. This is the best this group's looked in a while. Semiconductors, on a relative basis, they bottomed in April. They have not gone to a new low. If you're thinking the market's going a lot lower, you want to see this continue lower and take out that April low. Software, been pretty weak, but a subtle positive divergence in the relative strength. Electronic equipment bottomed at the beginning of May, turning up. Computer hardware, this one actually had been pretty strong all the way until just last month or so. Apple's had a lot of problems, but this one trying to turn back up again. Electrical components bottomed in April. Big move back to the upside. Is CNBC talking about any of this? I don't think they are. Renewable energy bottomed back at the end of January. Hasn't been great, but it's been holding its own. Does this look like a secular bear market? It does not to me. I think we're getting ready to turn back up. Anyway, that's what I had for today. 3 you must see. I'll tell you what, I'll just give you, talked about some Max Payne stocks last night. I don't know if we mentioned this one. Pinterest down here at the recent low, right around 17 and a quarter. There's a lot of puts. I wouldn't be surprised to see a move over the next couple of days to a week in Pinterest. Same goes for Snap. These stocks look horrible on their charts, but I'm just talking about the market inefficiency around option expiration Friday. These are stocks that have gone straight down. A lot of in the money put premium out there. Don't be surprised if the carpet gets pulled out from underneath a lot of these shorts as we head into option expiration Friday and even into the early part of next week. And then one that I wrote about in the EB Digest this morning, Amazon. There is almost $2.4 billion of net in the money put premium on Amazon right now. Amazon fell more than 20% in the last 6 days, and the net put premium exploded. Every dollar that Amazon rises from here will save $100 million on the put premium that has to be paid out on Friday, potentially, that value. So just think about that for a minute. What if Amazon went up $10? Would anybody really care? Goes to 112, still in a downtrend. That would save market makers $1 billion. We're at a triple bottom right now on Amazon. I wouldn't be surprised to see Amazon have a pretty strong finish to the week, maybe even go up into next week. Don't be surprised to see a 20-day test. I wouldn't be shocked to see a triple bottom, and this is it for Amazon. Amazon's one of those stocks I wouldn't have any problems buying here and holding. Right now, I don't own it. I may own it today. It's one that I'm watching pretty closely. Anyway, those are your three you must see. Let's see how the market opened. NASDAQ up 114, Dow up 240, S&P up 35. Doing pretty well so far. Small caps, mid caps up pretty well. VIX down 2%, back down to 32. We got up over 35. That's a level where we can see markets bottom. Equity only put call ratio. Last thing, let me pull this up real quick. I want to see what the 5-day moving average is up to. So yesterday was 0.83. So you can see the last 3 days have been above 0.80. Major bottoms this century have come with the 5-day moving average of this equity only put call ratio at least at 0.75. Now, the way you can get the 5-day moving average is first go down here and get rid of candlesticks, put in down toward the bottom, invisible chart. Now, if I just clicked on that, it would be invisible. So all you would see is the moving averages. Price action's gone. Well, the only moving average I want is the 5-day moving average. So I'm just getting rid of the 20 and the 50. And now I'm going to put that 5-day moving average. We just set a new high yesterday, by the way, 0.764. So if today, if we reverse, go back down, if we have one more day where the equity only put call ratio is up in the 80s or above, we could hit 0.80. The significance with 0.80, again, let me repeat what I said earlier. Of the 18 most significant bottoms since year 2000, this century, of the 18 most significant, 15 of them have seen 5-day moving averages of the equity only put call ratio get to 0.80. There were 3 that got to 0.75, but never quite made it to 0.80. So 0.75 is the threshold. I mean, if you're a historian or a statistician and you like stats like that, like 17 out of 17 times, we've been at least at 0.75. Well, guess what? We're there again. We could bottom based on that stat at any point in time. Now, like I said, 15 of the 18 got to 0.80. Now, we were coming off very, very low levels. So that might mean we don't get all the way up to 0.80. I don't know. But I'd love to see the market have one more weekday, one more big reading on the CPCE, and literally have a morning where everybody says that's it. The market has no chance. We're going to crash. I'm getting out. And then see the market reverse. Capitulation with all the other things I've talked about today, that would really make me think some very bullish thoughts. Anyway, that's it for me. Listen, come on over and join us at EarningsBeats. If you've been on the fence, 30-day trial. These next 30 days could be of major importance to your own financial being. It's a great time to check us out. Again, 30-day trial. We'd love to have you. Have a great day, everybody. Happy trading. I'll be back tomorrow over at Stock Charts TV for your next episode of Trading Places Live. That'll be at 9 a.m. over there. Just go at 9 a.m. Eastern, click on that Stock Charts TV, and it'll bring the show up. All right. Anyway, have a great day. Happy trading.